now turn my attention to the exchange rate. The exchange rate is simply the price of one currency relative to other currencies. For example, the Cedi relative to the dollar. At the basic level, it is influenced by relative demand and supply for the foreign currency. Factors such as the inflation rate, the balance of trade, the fiscal balance, the money supply. These are what we refer to as the fundamentals. These factors influence the exchange rate, but speculation and expectations about these fundamentals, external shocks such as oil price increases, can also have powerful short-term effects on the exchange rate. When we see pressures on the exchange rate, first we need to determine where these pressures are coming from and whether the pressures are transitory or permanent. And as every astute central banker knows, even with strong economic fundamentals, speculation, expectations, and investor sentiment can exert pressures on the exchange rate. Ladies and gentlemen, you will recall that if the fundamentals are weak, the exchange rate will expose you. That was true then. That was true then, and it is true now. It is 100% correct. So if the fundamentals are weak, the exchange rate will expose you. But it is warped logic to jump from that to a conclusion that if there is depreciation in your currency, then the fundamentals must be weak. Do you understand the logic? It is very warped logic. If the fundamentals are weak, the exchange rate will expose you. But if the exchange rate moves, you cannot jump to that conclusion that the fundamentals are weak. That defies logic. That defies logic. There could be other external factors causing the exchange rate depreciation. For example, if I tell you that if your leg is broken, you are going to be unable to walk, then I'm somewhere and somebody comes to tell me, this person is unable to walk. Can I just conclude that their leg must be broken? There can be other reasons why you are unable to walk. But the NDC logic will insist, in the face of contrary evidence, that since you cannot walk, then it must mean your leg must be broken. In 2014, the exchange rate depreciated by 31.3%. The fiscal deficit was 10.1% of GDP. The public debt rose to 70.2% of GDP. Inflation rose to 17%, and GDP growth had declined from 7.3% to 4%. In other words, the economic fundamentals had weakened significantly, and therefore the depreciation was easily explainable. It was not caused by dwarfs or high-rise buildings, as we were told. The exchange rate in 2014 had exposed the weak economic fundamentals. And if you look at the table on the screen, it gives you the fundamentals as we have it in 2014, and you look at them in 2018. Every single one of them, real GDP growth, inflation, the fiscal balance, wage bill to GDP, gross debt, interest rates, and all of that, current account, all the fundamentals, you will see we were in a much weaker position in 2014 compared to 2018. So, ladies and gentlemen, how has the Cedi performed recently? At the end of December 2017, the Cedi had cumulatively depreciated by 4.9%. compared to 9.6% in 2016. And this was the Cedi's best performance since 2011, at the end of 2017. We had the best performance of the Cedi since 2011. The Cedi, however, depreciated by 8.4% in 2018, largely on account of the emerging market pressures and US interest rate increases. The data, ladies and gentlemen, on the annual rate of depreciation of the Cedi in recent years, and you will see this graph here, it's like night and day. The data on the annual rate of depreciation of the Cedi in recent years shows that the worst performance so far under the MPP government, the 8.4% depreciation that we saw in 2018, that worst performance is better than the best performance under the previous government between 2012 and 2016. So our worst is better than your best. And then you say boot for boot. This one is more like boot for Chalewote. Ladies and gentlemen, the start of 2019 has been characterized by another sudden sharp depreciation of the Cedi, which was largely been reversed. Within a week, the Cedi went up close to 5.9 to the dollar, and then it retreated back to about 5.07, and even was threatening to go below 5. But this is really an unprecedented development, that you don't normally see such a retreat when the exchange rate depreciates. And this was also, and you see within, in the next graph, when we look at the Cedi dollar exchange rate, that you will see that in this period when there was a reversal in the Cedi depreciation, the Bank of Ghana had not intervened in the market. In fact, if you look at it as at the end of March 2019, the Cedi has depreciated by about 5.18% so far this year. But we have to understand how come we saw this sort of movement in the exchange rate at the beginning of the year, a few weeks ago. What happened? Why did it jump so far? Many, many reasons have been given, but let me tell you what happened. The most important and the proximate cause of the recent depreciation is the time inconsistency of an IMF prior action on the reserves target. At the end of January, as part of the 7 prior actions to get to the IMF board and the completion of the IMF program, the IMF gave Ghana 7 actions to complete before March 15. 7 prior actions that we had to meet. 7 conditions. One of the conditions that the Bank of Ghana had to meet was to increase its net international reserves to the level of December 2018. To increase the net international reserves, however, meant that the Bank of Ghana could not sell any foreign exchange in the market. They had to essentially hold their hands to the back and could not intervene on the market during this particular period. So demand for foreign currency was not met by supply as normally happens on a day-to-day basis. And we know when the demand is greater than the supply or the supply is not coming, the price will go up. And this is exactly what was happening. So to meet the Bank of Ghana, and the Bank of Ghana had to increase its reserves by about $800 million. And this explains, what was happening. So once the reserves target was met. We then had the IMF board meeting on March 20th, which passed Ghana. So this partly explains why the cedi came under such pressure. It was the primary reason. Contrary to some speculation, the Bank of Ghana did not spend any reserves to revive the cedi following the initial depreciation. Some people have misunderstood the requirement by the IMF for the Bank of Ghana to build up its reserves by some $800 million to mean that the bank used $800 million to reverse the cedi depreciation. That will not be wise. The reason for the sudden reversal in the sharp depreciation that we observed was that the market corrected itself. Investor sentiments, expectations, and uncertainties acknowledged that the fundamentals are much stronger than suspected. And even without the IMF, fiscal and monetary discipline are assured. The reversal of the depreciation that has taken place actually supports the fact that the fundamentals are indeed strong.